Hello, everyone. It is another Wednesday night, 8 p.m. Eastern, which should only mean it's time for Taxes and Retirement. Yay. I'm your host, Andy Panko. Thank you for joining me. I'm glad you're here. We have a great special guest tonight to discuss the topic of equity compensation. Now, it may not directly apply to a lot of you, especially if you're already retired, but nonetheless, I think it's a very interesting topic and one that may have applied, or for those of you who are still working, maybe currently applies. So found someone really great who I know through the advisor community. Have not met in person yet, as we are a country apart. But without further ado, let me introduce to you Meg Bartelt.
Hello.
Hi, Meg.
Hello.
Meg is the founder of Flow Financial Planning in Washington State, right?
Yes.
So I first, quick backstory, I listened to this podcast from the XY Planning Network, which is a network of independent financial planners, of which Meg and I are both members. But I started listening, I want to say it was like 5-6 years ago, before I started my business, and Meg was one of the guests on it, and just really resonated with me. She had a very clear picture of the business that she was trying to build and who she wanted to serve, and was very clear that equity compensation is a decent size of that, because she works with quote unquote women in tech.
Mm-hmm.
Right, Meg?
Mm-hmm.
That's kind of your focus. So you were the first person I thought of when I was coming up with ideas and decided I wanted to do something about equity compensation. I said, Meg, so thank you for saying yes to this.
You're welcome.
Let me just see if comments are working here. Yes. Cody Garrett. Yay, Meg. Do you know Cody from the XY community?
Yes, through the XY community.
Okay.
Same. Yep.
And I believe you know this fellow too.
It's me. Hi, David.
Oh, not to brag, but he's met you in person.
Yes.
Man. Okay, that was bragging. All right, we'll get to it now. Sorry. Before we get started, I got this bit that I do, Meg, with some dad jokes. And I did not tell you
I've
that.
I've been forewarned. Yeah.
They're so bad. They're good. All right. So when I first met my wife, who's then my girlfriend, I saw her, and she came over in a white suit covered in bee stings and dripping in honey. I knew she was a keeper. Hold on, they get worse. I have the attention of a goldfish. No, seriously, it's been watching me for hours. It's over there, and it is locked on me. Man, thanks. Okay. And finally, money related, not to brag about finances or anything, but my credit card company calls me almost every day to tell me that my balance is outstanding. You know what I'm saying?
That I know what you're saying. Yeah.
It's not, though. In full disclosure, credit card debt is one of the worst forms of debt you can have. It's okay to use credit cards if you pay it off and get the points, but do not carry balances.
Yeah. Okay.
Public service announcement.
Yes. There you go. I had to make that serious for a moment.
Yes. And finally, to protect both ourselves, Meg, this video is only general explanations and education. It is not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor, which neither Meg nor myself are. We're just two people talking about equity compensation.
There you go.
Cool. All right. Give us a little quick background about yourself, Meg. I sort of stole your thunder a little bit, I guess, but
yeah. I'll try not to repeat that, but
yeah.
So my first career was in the tech industry. So my 20s and early 30s, I worked in the software industry in the Bay Area, and then switched careers in my early 30s to financial planning. Started my firm Flow almost 6 years ago, and we're now a team of 3, and as I was telling you earlier, about to be a team of 4 next week. Yay.
Exciting.
Yeah. And our focus is a little more specific, a little more narrow than women in tech. It's actually women in their early to mid-career in tech. Okay. So actually explicitly excluding retirement planning, because that is such a robust and nuanced subject matter that I don't yet have.
Right.
And so we explicitly exclude people in their late career. And we have a specialty in pre-IPO and IPO planning.
Okay. Which I guess West Coast, well, you're virtual though, right? Or do you have local clients?
Okay. Yes, but sort of by luck. Yeah. So our clients are basically Bay Area, Seattle, and New York City.
Okay. And company name, for those who are interested, flowfp.com. Is this correct, Meg?
Yeah, although the dub doesn't need to be there.
Oh, look at that. Fancy. Without the triple dubs?
Yeah, I know.
How'd you pull that off?
I don't know. I did not. My web designer did.
Okay, very cool. Okay, so equity compensation pre-IPO, large part of what you do. I thought for tonight, if you can just kind of give an intro to intermediate level discussion, maybe just start breaking down and discussing the different types of equity compensation people may come across in their working lives.
Yeah. I think the easiest way to think about this is actually the kind of equity compensation you'll see a company give depending on the company stage. So
Okay.
really early stage company, it's usually going to be restricted stock. That's almost for founders. And ISOs, incentive stock options. Those are going to be really early stage startup type of compensation.
Okay.
As the private company gets bigger, you get into non-qualified stock options. As it gets even bigger, think like Airbnb, but before it went public, then you're getting into restricted stock units. So like giant company, they just happen to still be private.
Okay.
They will start issuing restricted stock units, RSUs. And once they become public, then oftentimes you'll get the additional layer of employee stock purchase plans, ESPPs.
Okay.
Which in terms of like sheer dollar volume is usually a lot less important than RSUs and options. But ESPPs only come once the company is public, and also the RSUs continue. I don't think I see public companies issuing options. There might still be options left from its pre-public time, its private time. But in terms of sort of new issuance of equity compensation in a public company, it's RSUs and ESPP.
Oh, really? Why not even non-qualified options? Just curious.
I don't know why. I just don't see it.
Okay.
I'm sure there's a reason. I just don't know what it is.
Okay. And what's so restricted stock, so pre-IPO early stage company, how does that look? Someone, stock isn't publicly traded. What do they actually get? How is it valued? Like what's that look like?
Yeah. In a private company, so let me contrast it to a public company. Public company, it's traded on the public market. Any time of the day, you can Google the stock price.
Yep.
Right. In a private company, you cannot go Google the stock price, but a stock price exists, a valuation of that company, and therefore of each share of that company stock exists. It's called the 409A valuation.
Okay.
And that applies both to sort of the total value of the company. But what's really actually important for you as the client or as the employee is what is a single share worth? Because not so much for RSUs, but specifically with options, that 409A, which is sort of like the real sort of price or value of a share, you need to know that when you are exercising an option, because that impacts how many taxes you owe when you exercise.
Okay. And so where, like with a public stock, this public-private compare and contrast, public stock, you have a brokerage account wherever, and you can see the shares in there electronically. With private company restricted stock, do you still have an account, or is it just like a certificate you get, or like?
Yeah, you do still have an account, and sometimes it's at major custodians like Fidelity.
Okay.
You got to have your private company stock plan could be administered at Fidelity, and you would see like all of your options, the ones that have vested and you could exercise if you wanted, the ones that have not vested and you can't do anything with until they do vest, the shares that come because you actually did already exercise options.
Okay.
So you could have that at some place like Fidelity. More likely it's going to be at, in my experience with the clients we work with, Carta, ShareWorks, which is actually now part of, I think, Morgan Stanley or Merrill Lynch. One of those used to be a private company, and then one of these like giant custodial companies ate it up. And yeah, Carta, ShareWorks, E-Trade, and Fidelity are the four companies I see most often administering these private company stock plans.
Okay. And how often are their shares valued? I assume it's not daily. It's like once a year, once a quarter.
Yeah. 409A valuations are supposed to be done once every 12 months. I think sort of the smaller private companies don't really hew to that requirement.
Yeah.
It's all supposed to also needs to happen every time there's a new fundraising round, because anytime a private company raises money, that changes the value of the company.
Got it. That makes sense. And as the employee with said restricted shares you want to sell, assuming they're vested, or options you want to exercise, are you limited in timing? So like, what if the valuation was done December 31st and it's March and you want to exercise?
So we're still in the private company world?
Still a private company world, sorry.
Yeah. Your company can impose blackout dates to exercising options. I have seen that happen when a fundraising round is the company's in the middle of doing a fundraising round, because the fundraising itself will change that 409A value.
Yep.
And you cannot know what the tax impact of exercising is without knowing the 409A. And so some companies just black it out. No, you may not exercise now. Or if you do, you will have to use the 409A valuation that is accurate at the end of the fundraising round. We don't know what that is yet.
Right.
So you're really taking a gamble that you'll have this huge tax bill because you don't actually know what the tax hit will be until the 409A is newly calculated and shared with everyone. I will say, some private companies are great at sharing 409A valuations, right? You just go to like the company intranet and boom, like one page is just history of 409A valuations. Wonderfully, easy to access. And some companies suck at this. And it is really hard to get this information. And without it, you can't making any decisions about your company stock without the 409A is foolhardy.
Because you have no idea what it's worth.
Yep.
And no idea what the tax impact is if you do anything with it. Yeah. Okay.
Yeah.
Okay. And one more question while we're on the private company thing. You mentioned that if they do issue options, it's likely incentive stock options, which, not to get too down a rabbit hole, but more tax favored to the employee, to the option owner, but with the wrinkle that it could trigger the AMT, alternative minimum tax. Actually going through that with a new client now, which completely takes away all the benefit that there otherwise would have been in her case, at least. But without getting to the hairy tax details of those, why are early stage or private companies more likely to do incentive stock options as opposed to non-qualified, which is for public companies more common, if not the sole thing they have at this point?
I don't actually know. I think I've read that somewhere. The tax code and sort of the regulatory requirements are the reason, sort of at a very high level, but I don't know what the regulations are to be able to explain why it is favorable to companies to issue ISOs when they're earlier stage private, NSOs later stage private.
Got it.
Yeah, sorry.
Okay, that's good.
in the universe of information to know about equity compensation, I try to restrict myself to knowing only the things that are actually useful for my clients to know, or for me to know on my client's behalf. And sort of regulations that affect company decisions it's not like the employee has the ability to control that or not. Yeah. But yes, an explanation exists. I just don't know what it is.
It's somewhere. It's out there.
Yes.
Yeah. One more thing about private. Now, I guess segueing into public, when a private company goes IPO, goes public, what happens typically if you have restricted private stock or if you have incentive stock options on restricted shares? Are they force converted to public equivalents? Are you cash out at the time, or can you still somehow carry legacy private shares?
Yeah. Typically nothing is forced.
Okay.
I will say the only forcing that I see is when you have restricted stock units in a private company. So let's roll back before we go public. You've been getting restricted stock units, RSUs, which are different from restricted stock.
Can you break that down while we're on it? What is the difference?
The practical difference is that almost everyone watching this is going to get RSUs and not restricted stock.
Okay.
Restricted stock, I see, as I mentioned earlier, much earlier stage and almost like at the founder level, or like very, very, very early employees. Okay, so restricted stock in a private company typically will have what's called a double trigger vesting. What the hell does that mean? Well, in a public company, it's always helpful for me at least to sort of compare and contrast the public and private. You work in a public company, you get an RSU. You have to wait for that RSU to vest.
Mm-hmm.
And when it vests, that RSU actually becomes a share of the company stock that you now own. You have one RSU in Microsoft. You wait a year, it vests. Hey, now I own one share of Microsoft. Awesome. Okay. And when the RSU vests, you owe taxes on it that very day, right? Which, by the way, means that there is no tax reason to hold on to RSUs once they vest. You might want to hold on.
You're already paying in full.
You're
once
already
you
paying.
Right?
There's no way to get around that tax liability. Okay. So now let's pretend it's a private company. If a private company RSU acted the same way, you'd have an RSU in this private company. It would vest because you've been working there long enough. Okay. It's still private. That RSU becomes a share. And now you owe income tax on, oh crap, this share in a company stock that's private and not liquid. And now I have to like dig into my piggy bank to pay taxes on this share of a stock that I can't sell because that's a private company. So what most companies, not all companies, but what most private companies do is they have a double trigger vesting, which means not only do you have to have be there for a certain amount of time, it's called a service or time-based requirement, but also you need to have a liquidity event, such as, and most commonly, going public.
Got it.
So we helped a lot of clients with the Airbnb IPO. So that is sort of the anecdote that I will go back to. The day that Airbnb went public, I think it was December 9th in 2020, everyone's RSUs that had already passed that first trigger, meaning they'd been at Airbnb long enough as an employee, they all vested on IPO day because that was the second trigger.
So they can then immediately sell to liquidate to generate the cash to pay the taxes?
Yes. Well, this is where your original question was something about sort of things being forced on you.
Oh, okay. Right. Yeah.
When RSUs vest, there is a certain minimum amount of shares that are either withheld or automatically sold in order to pay taxes. And that is outside your control.
Okay.
The problem is that often there's the statutory rate at the federal level of 22%. 22% of the shares will be held to cover taxes, right? So if 100 RSUs vest, 22 shares are going to be withheld to pay your federal taxes. Well, if you're working at Airbnb and you just had $1 million worth of RSUs vest, your tax rate is not 22%.
Yeah.
It's 37%. That's actually a slightly bad example because once it gets up to $1 million, the statutory rate is in fact 37%. Let's say you have $800,000 of RSUs vest. Again, your tax rate is 37%, but they're only withholding at 22%. Just want to throw that in there because the under withholding on RSUs in public companies is a constant problem, and people usually need to pay estimated taxes to make up for it.
I didn't think about that. Can you have them take or withhold more than 22%, or it's always going to be 22%?
Yeah. You know? So left to their own devices, companies will withhold at one of two levels: 22%, unless they know your income is above $1 million, and then they'll withhold at 37%. Not that they have a choice; that's the statutory minimum. Some companies, I believe Google comes to mind, do allow you to opt for a higher withholding. That's rare. And when Airbnb went public, they actually allowed their employees ahead of time to choose, all right, on IPO day, all your RSUs are going to vest. Do you want to withhold at 22% or 37%? So they did offer their employees that choice. That's uncommon. Usually it's just 22% withholding for federal taxes.
And how about state? Especially, I guess a lot of these folks are in California, which is you hit the 13% top rate, whatever it is, pretty quickly.
Yeah, that's usually not a problem. Enough taxes are usually withheld for state taxes.
Okay, got it.
Yeah.
We had a question. Where'd it go?
Okay.
I know we talked about this before. PSUs wasn't really
wasn't
ideal.
One
Here we
form of
go.
equity compensation.
So
Yeah.
whoever posted this, Meg and I chatted briefly before, and I said let's talk about RSUs, PSUs, options, and she said PSUs haven't quite seen a lot, but anyway, what do you know about PSUs? Meg, anything to share with this person?
Yeah, I mean, my basic understanding of PSUs is that, let's start with RSUs. RSUs are shares of stock that you will get as long as you stay at your company long enough. We're talking about a public company. Like, all you have to do is sit your butt in your seat for long enough, and these shares will become yours. PSUs are going to be tied to performance. I think perhaps not just in if you get them or not, but also the number you get. I actually think I do have one client who works for an energy company who has PSUs. I'm not sure now that I'm saying that, but yeah, I honestly can't speak usefully to PSUs.
Yeah. Okay, but functionally, what you get though, to my knowledge, correct me if you know otherwise, Meg. I do believe there are performance-based metrics you have to hit to get X amount of PSUs, as well as a time, button share element. But as far as what you get when you do get them vested, regardless of what the vesting formula is or how many you get, once they're vested, I believe they function like RSUs in that you realize the entirety of that vesting as taxable income that year. Does that sound right?
That certainly sounds logical. Yeah.
Okay. Yeah. Yeah, I believe that's the case. So similar to RSUs, once you get them, they sort of work the same from that point forward, I think. I've only come across them once and I've kind of forgot the details.
Yeah.
But.
Yeah, I mean, if they work like RSUs, once they vest, it doesn't matter that they came from PSUs or RSUs or anything like that. You now own a share of stock in your company, just as if you'd gone out to the stock market, to your Robinhood app or whatever, and bought it.
Yeah.
And your decision on whether to hold or sell it needs to be predicated on that. Hey, I just own a share of stock. It doesn't matter how I got it.
Right. Do you want to keep that exposure to that company? Right?
Yeah.
That investment.
Yeah.
I don't know if this is the same person or not, but PSUs at Verizon were based on the targeted performance of the company for the year. They do.
Hey, I learned something new. Awesome.
There you go. Awesome. Facebook. It's for the kids. Everybody loves it. What's this? Here's a question. Isn't there a 60-day rule associated with cashing RSUs at IPO of a private company?
I don't know what cashing RSUs means.
I guess maybe selling out of the shares, or maybe this ties to IPOs in general. Is there restrictions around buying and subsequently selling IPO shares within X amount of days? Or I guess if you receive IPO shares from being private, are you restricted on when you sell them? I don't know enough about this.
Certainly, once a company is public, employees are subject to blackout dates and conversely trading windows. But that has everything to do with basically restricting insider trading and insider information.
Okay.
The 60-day rule, I mean, honestly, that sounds a little bit like they're talking about the wash sale rule, but that would only apply in a public company. If the person could reframe that question, because I've never heard the phrase cashing RSUs.
Okay. Got it. Thank you. David Myers, your friend David Myers, here's his take on how to explain RSUs. Basically, like you said, you got a cash bonus and in effect opted to buy shares with that bonus. Is that actually what you wanted to do? If not, then you can simply sell the shares and everything's great. Yeah. Okay. All right. So options now. So we kind of touched on incentive stock options, which are their own fancy flavor of options. But I think let's assume we're in the public company world now. People are, if anything, if they do have options, likely non-qualified stock options. Can you give a quick rundown what those are, how they work?
Yeah. Let me back up just a bit. Because we work with so many clients in private companies, some of those companies have gone public. So we actually do work with a lot of people who have ISOs in public companies.
Okay.
Just because they were granted ISOs while the company was still private.
Got it.
And the company going public doesn't change anything about their possession of ISOs and the vesting schedule and all of that. So there are still people out there who have to make the decision of, do I exercise and then do I hold or sell these ISOs in this public company?
So what they had was an incentive stock option to buy one share of the private company. When the company goes public, they still have the option to buy one share of what's now a public share.
Yep, and the
Same thing?
exercise price is the same. All
Okay.
of the terms of that stock option grant are the same. The expiration date is the same. The strike price is the same.
Oh, cool. Okay.
Yeah.
Got it.
And you were asking me about NSOs, but then I forgot what it was.
Just basic primer, non-qualified stock options. Can you give a quick rundown what they are, how they function in terms of grant, vest economics to the recipient?
Yeah. So NSOs, like ISOs, at grant, nothing happens.
Okay.
Right. You're just like, yay, I've got these things that I could in the future choose to turn into actual shares in my company.
And so grant just means, for folks listening, grant just means, hey, your company says, I will give you these at some date, right? The date they make that proclamation is the grant date. Is that a fair enough explanation?
Yes.
Okay.
Yep.
Got it.
Right. So on grant date, they say, we are granting you 1,000, in this case, NSOs. Now, they're not actually yours right now because they have to vest, usually over 4 years. But now that we've granted it, that vesting clock has started.
Okay.
All right. And so along the way, these options vest. And once options vest, now you can choose whether or not to exercise them, pay the exercise price, and get a share of stock in return. And I am ignoring the concept of 83B, early election, right now, which does allow you to exercise before they have vested. That complicates the conversation. All right. So at grant, great. No, wow, I'm getting dark here. Like, where'd my light go? Okay. So no tax impacts at grant. Eventually, these options start to vest, which means now you are able to, if you want, pay the strike price, otherwise known as the exercise price, to get a share of the stock. When you exercise an NSO, whether it's a private company or a public company, you owe ordinary income tax at that moment on the spread, on the amount of money between your strike price and the value of the company share. Private company, that means the 409A. Public company, that means the price that you can go look up on, Yahoo Finance. So NSOs are, they're very straightforward tax-wise. You exercise, you owe tax. There are really not a lot of games to play there like there are with ISOs, where you can exercise and not owe any tax at the time of exercise.
And when you exercise, it's ordinary income, right?
Yes. So it's like your highest tax rate.
And is it wages? Is it subject to Social Security and Medicare tax, or no? It's just like other income.
Yeah, I think it goes through payroll.
Okay.
Yep. But check that.
Sure.
Don't take my word for it.
Our disclaimer covered us. We're good.
Yeah, I can be completely wrong.
Say anything.
Yeah, I'm actually going to change my light. Sorry, because the lighting has changed in the last 15 minutes.
That's fine.
Let's see if I'm not just like sitting. Hey, that's better.
There we
go. Okay, so we got grant. We got vest. Again, at vesting, there's no tax impact because you haven't done anything yet.
Mm-hmm.
And it's only at exercise that there's a tax impact. It's ordinary income on that spread. And I will say that one of the questions is, the question is, should I exercise my NSOs? Like, when should I? And when I do, should I hold or sell the resulting shares? In a public company, my belief, and it's widely shared, though not universally shared, is that NSOs should not be exercised and held. They should be exercised and sold.
Okay.
Which means you want to wait until the price of the stock is pretty high. And this is because of the idea of leverage. And we all are probably familiar with leverage when it comes to buying a house.
Mm-hmm.
You put $200,000 down, you get a mortgage for $800,000. That's good leverage. The way to calculate leverage, because I'm going to give sort of a rule of thumb here, leverage in a stock option is, what is the strike price? So let's say it's $50. And what is the stock price? Let's say it's $100. Actually, let's redo this so I can be more extreme. Strike price is $99. Strike is 99, stock price is 100.
Okay.
Right? So I've got really high leverage, 99%. Right? Who cares about leverage? What does that even mean? Well, on the surface, if your strike price is 99 and the stock price is 100, the value of that option is $1, right?
Yeah.
Let's ignore taxes for now. If the company stock increases by $1, the value of that option has now gone from $1 to $2. It has doubled. The stock price increased by 1%, and your option value just doubled. Holy crap, that is nice. Like, I don't want to get rid of that yet. I am going to hold on to that option, because the company's stock price doesn't have to go up by that much for the value of this option to just explode, right? Well, let's take it on the opposite end. Strike price is $1. Let's see if I can see my hand here. Yes. Stock price is 100, right? Well, now I've got a leverage of 1 divided by 100, 1%. Company stock price goes up by 1. Now the value of that option goes from $99 to 100. Well, percentage-wise, like, that's practically the same. The stock price went up by 1%, and the value of the option went up by roughly 1% also. Right. Like, you don't have a lot of leverage left there. Leverage is good in options, right? It helps you turn just a little bit of your investment into a lot more money.
Right.
So if 99% leverage is great, you want to hold on it, and 1% leverage is crap, and you might as well exercise and sell, where does it switch? And I have a value at around 40%. Okay. And that's not like based on some like multivariable calculus equation. It's mostly just a measure of, all right, I've eked out most of the value of this option. And we have one client who works for Netflix, and Netflix, basically their compensation is salary and then a whole lot of non-qualified stock options. And so this is a rule of thumb that we use with her a lot. She'll get non-qualifieds, and then we'll just wait until the leverage drops below 40% to exercise and sell. And actually, one of my favorite blog posts out there is on the Stock Opter website. And it's called something like NQSO No. And it's talking about this idea that people think they should exercise their NSOs and then hold them. It's like, no. Because you are incurring ordinary income tax at the moment of exercise, and you're losing, like, quite literally the optionality of the option, and you're losing all your leverage, because once you own the stock, there's no leverage left. Right. Stock price goes up $1, your value goes up $1. Goes down $1, your value goes down $1. Once you have lost the leverage and the optionality, and you've already incurred the ordinary income tax, like, it is, statistically speaking, it is not smart to continue holding. Sure, it's always possible that it'll end up being the right choice.
Sure.
To hold on to it. But statistically speaking, you shouldn't. You should just hold on to the option. Right? Because if you hold on to the option, you haven't put any of your own money at risk. As soon as you exercise it, your money is at risk.
Right.
Right.
And this is all predicated on the assumption that the company shares will go up over time, which I would hope most people think that's the case with their companies. But to the extent you think your company is trending downward for whatever the reasons may be, does that change analysis? Let's assume the option's still in the money, so the market price is higher than the strike price. And now we're sort of getting into market timing, I guess, and speculation. But would that change the analysis for you or the client?
No. Certainly our clients have big feelings about their companies.
Yeah.
A lot of time it's very positive feelings. Like our Airbnb employees who are clients, boy, oh boy, they have very positive feelings. Sometimes clients, like, especially their private company clients, some of them feel very negative about the prospects for their companies. And I'm happy to honor that sort of that faith, that belief.
Mm-hmm.
However, from our perspective as financial planners, we put zero stock in predictions of future stock price. You could just look at the last few months in the tech industry to see that any faith in stock prices going up has been misplaced with most companies.
Mm-hmm.
So what do you do then if you have no idea? And in my world, I have no idea what the company stock price is going to do in the future. So we're being forced to, you have to make a decision, exercise or not, hold or not. In a world of complete uncertainty, right? Because the right decision to make there is predicated on stock prices in the future, which are unknown and unknowable. Well, if we can't know future stock prices, what do we know? Well, we know you. We know what your goals are. We know what money you need to fund the life you want. And you know what? That's actually infinitely more important than some arbitrary dollar amount in the future. So I find that when we are able, like when we're taking all these clients through IPOs, if we start the conversation, we ground every conversation in, okay, what's the life we're trying to build for you, right? Things from kitchen remodel to early retirement to sending kids to college, blah, blah, blah. We can assign dollar values to that. And also sort of importance, like, yeah, I'd love to take that vacation, but if it doesn't happen, it doesn't happen, versus, no, I need to send my children through college. That is not negotiable. All right, well, then we probably shouldn't tie that to the future stock price of this single company share.
Right.
And so when we get clear on that I don't even have to try to convince clients to sell stuff. When we can tie their equity compensation decisions to what they definitely need in their life, to what, and also to like, oh no, I mean, I've got enough for what's really important to me, and if the rest of this like goes to zero, that would suck, but I won't be sacrificing anything of true like core value. Great. Let that go. Like, let's roll the dice. Let's see what happens, because if, very unlikely, but if it 10x's in value, boom, you just qualitatively changed your life, which, a low cost, broadly diversified global portfolio is never going to do.
Right. Not without 100 years of time.
Yeah, right. Right.
Yeah.
That's the best, most reliable way to like steadily grow your wealth. But if we're talking about like changing your life over a short period of time, concentrated bets like keeping all your company stock, that's kind of the only thing you've got going.
Right. Assuming, which is a great lead-in into this. So David Fultz coincidentally asked, do you find people keep their company stock versus only keeping a small portion, investing the rest in a diversified portfolio?
It's a mix.
Yeah. So it sounds like, I don't want to put words in your mouth. Let me rephrase or paraphrase, whatever. What I think I heard you say was not great to have an undue amount of concentration in your company's stock, but if you have enough money and relative safety or diversification of investments that cover the goals you want and need, then it's not so bad then to attempt to 10x your money by having the concentrated position in a company that may hopefully hit it big. Is that kind of fair to say? Okay.
Yeah, that's, I think, a fair characterization of what I just said.
Okay.
Yeah, I find two metrics are very helpful in guiding the conversation around equity compensation. We very rarely as advisors come out and say, you need to sell X shares or Y dollars of company stock. We calculate how much of their net worth is tied up in company stock. And if you're a 33-year-old and you just went through the Airbnb IPO, it's usually between 80% and 90%. And so we'll just say, hey, 80% of your net worth is tied up in Airbnb stock. What do you think? And not 201, but most of our clients be like, whoa, that's a lot. Yeah, I think we should probably sell some. so, even though there is this best practice in our world of financial services or financial planning that you shouldn't have a concentration of more than 5% of any single investment, I'm not going to tell a 33-year-old with 85% of their stock, 80% of their stock in Airbnb, this company they love, whoa, you've got way too much Airbnb stock. I think we should sell like 90% of your company's stock, like right now. Let's get down to 5%.
Yeah. Right.
But showing them that concentration of net worth is very powerful. And also, again, going back to those goals and assigning numbers to them, right? Hey, you said it was really important to pay off your mortgage or do a remodel or fund your kids' 529s. Altogether, that costs $500,000, whatever the number is.
Right.
What do you think about selling at least $500,000 worth of company stock? And we can deal with the rest later. But at least then you will know little Jimmy's going to school and won't have any debt.
You de-risked enough money to cover that.
For the really important things. And it's not like I'm being heavy-handed with it. That really appeals to a lot of people, especially because it's sort of it's a compromise, right?
Sure.
Like, ooh, I still get to keep some because if I missed out, if I sold it all and then it went to the moon, yeah, exactly. I am very much like a compromisey kind of approach to this, just because I think the risk of being extreme and then being wrong,
right,
even if the financial impact isn't great, the regret would be daunting.
Yeah, and that's important. I think a lot of what we do and the value we provide is that it's lay out the pros and cons. It's to be the sort of third party objective ear or objective voice, I guess. And I guess if someone's doing something so glaringly dangerous to themselves, then we're kind of obligated to step in and say something and maybe push your hand a little bit. But otherwise, like you said, lay out sort of what could happen on the best end, what could happen on the worst end, and what's important to you, what's not, and go from there, right?
Yep.
Yeah. One more question. What is this? I think we answered before. Sorry. Got it. Yeah. So we talked about
yes,
that.
we think so. Check.
Good question.
Check your pay stub next time you exercise an NSO.
Yeah.
Or Google it. You can definitely find this on the inner tubes.
Yeah. Inner tubes. Quick question actually for you with a client I started working with. So with incentive stock options, it is a public company. I don't remember when it went public. I'd have to look that up. A handful of years ago, I think. Exercised some last year before we worked together. Got hit with a chunky amount of alternative minimum tax that negated the long-term capital gain tax benefit she would have normally gotten on it. So now the analysis this year is she still has fairly high salary. If she exercises more this year, she'll similarly be hit with AMT. Is it potentially better just to do the disqualifying disposition, which is when you sell it effectively immediately after exercising so you don't qualify for long-term gain, and run the numbers? Have you come across scenarios where that has indeed worked out better? Just let it be hit with ordinary income tax instead of AMT. I guess it all depends on the specifics and circumstances.
Yeah. So I will say that it sounds like you do a lot more tax analysis in-house than we do. We work very closely with our clients' CPAs.
Okay.
That particular decision or sort of scenario you're describing, to me, would be driven less by how will the qualifying versus disqualifying disposition affect the tax rates, and more by why are we exercising? What do we need the money for? And maybe this is just like my convenient excuse for not like having to get into the tax weeds in my own practice. But that generally points the way to the right decision. And then the CPA can figure out how to sort of optimize the tax situation.
Got it.
But I always want to start with, what are we using the money for? Either now or the hoped for proceeds in the future.
Yep. Yeah. In this scenario, it's near traditional retirement age. Company has done really well stock price wise the last handful of years and dropped 20% in the last 2 months, as a lot of high flyers have. and 50 something, 60% of her net worth is in this company. So that's driving the decision to de-risk some of this. We're, we're taking it down. My rule of thumb is sort of 10% to any single name is a lot. Beyond that, we start having serious conversations. So we're going to start working more toward that. But the immediate goal is you got to get rid of some of this, diversify away some of this exposure. So that's driving the why. Now we're trying to figure out tax wise, because AMT was such a slap in the face to her last year. It's like, might be better to not do that and just pay ordinary tax, but I'll worry about that. Okay.
Yeah. I mean, it's an interesting environment to be in with ISOs right now because company stock prices have dropped so much recently. That when stock prices drop, that is oftentimes interpreted as, this is a great time to exercise and hold, right? Because we think that the stock price is in fact sort of artificially low or lower than it will be in the future. So what does that do? Here's the strike price. Here's the normal stock price. Ooh, it just dropped 20%. Smaller spread, less either AMT income for ISOs, or I know this isn't your scenario, but less ordinary income for NSOs. So for ISOs, oftentimes in low stock price environments, that's an encouragement to exercise and hold. You can exercise more ISOs before you reach that AMT threshold.
Ah, good point. Yes, right. Because the dollar amount of recognized gain from it would be that much smaller.
Yeah.
Okay. Interesting.
But yeah, it does seem like in your case, the driving consideration really is we need to secure money,
right? Yes.
To support your retirement. That's the driving consideration, not how do we minimize the tax rate applied to this money.
Exactly. Yeah. Cool. I didn't read this. You have a question / comment from Cody. I see that many employees keep a majority of their net worth tied up in company stock to avoid the tax impact, waiting for their income to be lower in retirement before diversifying with tax harvesting. How do you experience and discuss the tax tail wagging the dog behavior within the families you serve?
Yeah. Well, interestingly, I mentioned earlier that we work specifically with people in their early to mid-career, and that really does change the sort of emotional and intellectual framework around this stock, right? You're 55 and you make a decision that ends up being the wrong decision. It's like, ooh, you don't have as much time to recover from that. You're 33 and you make a decision that ends up being not the right one. Dude, you've got like 3 more decades before traditional retirement age.
Lots of years of earning.
Yeah. So it really does take the pressure off. I will say in my firm, we generally attract people who are cool with diversifying. We do have a few clients who are like, no, I realize that 35% of my net worth is tied up in Airbnb and stock, and I'm cool with that because you know what? I've got these other financial resources, my income, the rest of my portfolio that I know will serve, my needs right now. My philosophy when it comes to equity compensation and really most financial planning decisions is it's not my decision to make. It's not up to me to convince a client to do this or that. And partly because that's scary as shit, right? Like, what if I convince them to do X and then X turns out to be the worst decision?
Not good. Yeah.
Right. So, I mean, it's a sort of a self-serving philosophy, but also like you learn anything about therapy or coaching or anything like that. And the best decisions, the decisions that people feel the most confident in, the most invested in, the decisions they're most likely to implement and stay on top of are the decisions they make and that they feel emotionally attached to. So how do you equip a client or a person of any sort, whether they're your friend or your parent or your client or whatever, how do you equip them with, yes, the technical knowledge they need to know, like the basics to understand the implications? Because Lord knows, I lived through, the dot-com crash in the early 2000s, and there was just some fundamental ignorance that got a lot of people in trouble. And then just to keep reminding them of what's the money for, what money do you need, and what money would just be icing on the cake. And if you can make that division for the money they need, like the cake itself, I find people are really quite willing to sell. And then when it comes to the icing, sometimes they want to keep the stock. And sometimes just getting them to sell a little bit, just like it breaks the psychological logjam. Like,
right.
oh yeah, I actually can click the sell button, or allow you to click the sell button. That was easy. I actually am sleeping fine at night, even though I own less Airbnb stock now.
And it didn't hurt. Didn't hurt as much as I thought it would. Or it didn't hurt at all. Yeah.
Yes. As it turns out, it didn't hurt at all. Yeah.
Interesting. That's cool. Yeah, I never really thought about that. Again, I don't really work with many folks that have concentrated equity positions, but I like the way you broke it down, that basically don't put more at risk than you're willing and able to take for the circumstances you want in life, you want and need, and financial scenario. That's definitely good to know. Now, generally speaking, with these various forms of equity compensation, just to tie us into retirement, if you do retire, whether it's 45 or 65, what typically happens? Is there, whatever vesting schedule you had outstanding, is it generally accelerated or something along those lines?
I mean, the lame answer is read your grant document, because your grant document is going to tell you what happens under various events. Termination from the company, which can be you're fired, you're laid off, you quit, you retire, you become disabled. All of those different situations or different scenarios are addressed in the grant document. So you'll know if the options will be accelerated, whether you will just lose them, whether you've got a 90-day window to exercise them, whether the expiration date, remains intact, and maybe that means you have another 5 years. You have to read the grant document to understand that.
Okay. And just coming up on time here, the other form of equity compensation we touched on solely for public companies, perhaps ESPP, employee stock purchase plan. Can you give a rundown about that? What it is, how it works?
Yeah. Highest level definition, your company allows you to buy company stock at a discount.
Okay.
So purely based on that, it's kind of like getting free money, right? If your company's stock is worth 100 and they allow you to buy it at 85, well, you can then turn around and sell it at 100. Woo! Free $15 pre-tax. Now,
how's the tax? I should know this. How's the taxation of that, though? You buy something at an immediate discount, flip it the next day.
Yeah. Flip it the next day. It's all taxed as ordinary income.
Just simply the gain is, right? Like
yes,
fact,
okay. Yes. Yeah. Yep. The dollar amount of the discount you got. ESPP taxation is, in fact, I think, by far the most complicated tax treatment of all forms of equity compensation. With regular stock, there's this idea of short-term capital gains and long-term capital gains, right?
Yeah.
You own it for at least a year, great. Now you get taxed at the lower long-term capital gains rate, and it's that year threshold that's really the only thing you need to worry about. With ESPPs, first of all, there are two components of the stock you now own. There is the gain since you purchased it, and also the discount you got on it.
Okay.
And so you have to hold it for not only a year since acquisition, but also at least 2 years since the beginning of the offering period. You define that later. And then each one of those components can be taxed differently. Ordinary income for the discount, and either ordinary income or capital gains for the subsequent gain. But also, like, let's say you get it for 85 when it's worth 100, and by the time you sell it, it's worth 90, or let's say it's worth 50. Different that chops up all those pieces of income into little bits, all of which are taxed differently. So I just throw my hands up. So with ESPPs, it is the most guaranteed gain if you just sell it as soon as you get the stock. It maximizes your tax rate. If you are going to hold it, pray that it goes up, because if it goes, just for obvious
Right.
reasons. And also it going down complicates the taxes. And plan to hold it for 2 years so you get a qualifying disposition.
And you said 2 years from grant. So is that 2 years from when
The
you
beginning of the offering? Yes.
offering? Right. Sorry.
Yeah. So an ESPP, a plan, has an offering period in it that's chopped up into purchase periods. A very typical arrangement will be an offering period is 2 years long
Okay.
and has 4 6-month purchase periods in it.
Okay.
So you say, oh, hey, yes, company, I would like to participate in the SPP, and I'd like to participate, to the max amount, which is a maximum of $25,000 worth of stock during 1 year. So this money gets withheld from your paycheck, every paycheck, and it basically just gets put in what you could consider an escrow account. So you just have this cash stockpiling for that 6 months. And at the end of 6 months, your company takes all that cash that's been piling up and goes out and buys your company stock at a discount. Yay, now you own company stock at the end of this 6-month purchase period. And you can do that again for the subsequent 3 purchase periods. And at the end of every 6 months, you're going to acquire more stock. If you sell it immediately, you're going to get taxed ordinary income on that discount amount.
Yep.
It was worth $100, you bought it $85, $15 will be taxed as ordinary income. If you want to hold it for the better tax treatment, you have to hold it not only a year from when you bought it, but also 2 years from the beginning of that offering period. So, you can see why this is complicated. Let's say you're in the first purchase period of that offering period. So the first 6 months, you get stock. You're like, all right, I'm going to hold it so I can get the awesome tax treatment. So you need to hold it for not just a year, but in fact, a year and 6 months. Because in a year and 6 months, you will now be 2 years away from the beginning of the offering period.
And do you know if the custodians take it upon themselves to properly report the taxation of this stuff and the timing of these things? Or I guess it depends on the plan, maybe.
I don't rely on that. I don't know if I can. It's possible that, my sort of cynicism about the custodians getting it right was set years ago and hasn't evolved with the circumstances.
Sure.
But it would they definitely report sort of all the various bits. I would just always double check that they got it right.
Got it.
And that your CPA, like ESPPs are pretty complicated tax-wise, and there are many like dates and prices that you need to know about in order to calculate your tax liability correctly. So not just any like Joe Schmo CPA is going to know how to treat this. So pick a CPA who's familiar.
I had an example of being that Joe Schmo just last night, actually. Not with ESPPs, but a friend of mine I used to work with at a prior company. Been doing his taxes for a few years, and fairly straightforward, except that he dabbled in some listed options on indexes. And I didn't realize it's a special definition, section 1256 option contracts or something. If you hold them over year end, they're treated as a straddle and you got to mark them to market. And anyway, long story short, I messed up his tax return last year. I didn't realize it until this year. So earlier today, I did an amendment. I had to learn myself more about the rules around taxes on options. And that was a fun exercise. But completely my fault for not knowing it. It was not cool. But I learned from it, and I enjoy learning. So I got that out of it. Grossly undercharged for the amount of time I put into this. But again, it's my fault, not his. So anyway.
One thing I did want to mention is that if you work in a public company, often you have multiple forms of equity compensation. Commonly, you will have RSUs and ESPP. Mm-hmm. And to get back to those questions about like, hey, what about clients who want to hold their stock? One dividing line I can sometimes say is, hey, if you want to hold stock, hold the ESPPs, right? Because there's actually tax benefits to holding. There's no tax benefits to holding RSU shares.
Right.
And oftentimes having that almost arbitrary division, but at least it's very clear cut, is enough for clients.
Right.
They get to scratch the itch of holding.
That makes a lot of sense. One final, we'll wrap up here. Just Dave Myers. This goes back to what happens upon retirement. So he has a client who left her company after being old enough for it to be called traditional retirement. Because of traditional retirement, she was able to keep her unvested things on the same schedule. I guess the gist is, if you leave or do them wrong, or if you're young and it's viewed as you're quitting to go to another company,
Yep.
then they may yank these from you prematurely. Whereas if it's retirement, they'll let you
Yeah.
keep it, right?
Yeah. And, for all I know, that is the usual.
Okay.
But I just know that exceptions occur for everything. So you have to read your grant document to see how your vesting works, how it can be changed, change of control. If you're in a private company and you get acquired, reread your grant document, which admittedly it sucks and it's not easy to read. And,
Yeah.
There's nothing we can do about that.
I read on your website you like, what is it? Historical English royalty and anything Russia. So who knows? My point is maybe some people like reading grant documents.
Oh, okay. I was like, that was quite the segue.
No, I despise reading. I can't sit still, but I realize the benefits of reading. But no, just goes to show, who knows? Maybe there's some people out there who like reading grant documents, like you like reading about ancient European
you
monarchies.
Enjoyed learning about Section 42 BC or whatever you were just mentioning.
It's case in point. Touche, exactly. Like
that sounded like
that
horrible.
That captures my attention. I can sit there and read something technical and thick, but I cannot for the life of me read fiction or any other history, unless it's about World War II. I've taken a liking to World War II history for some reason, but anyway. All right. Well, thank you very much. Again, if anyone is looking to find you, I took away the triple dubs this time. Flowfp.com.
Yeah.
Again, you've been spending the last hour with, where to go? Let me find it. Look at that. Meg Bartelt, founder of Flow Financial Planning. So if anyone's interested in Meg's awesome expertise about equity compensation, or if you're a woman in tech, early to mid-career tech.
Early to mid-career, that's right, baby.
Meg is without doubt the person for you. So cool. Well, thank you very much, Meg. I greatly appreciate being on. Lots of great questions here. Just taking this off the screen. Yeah, lots of great questions. I learned some myself, so that this was fun all around.
Good. Thanks for having me on.
Stick around for a second. We'll just recap here. And thank you, everyone, for watching. We'll see you next time. Take care.